All right, welcome back to another edition of Financial Accounting. So, a quick look at the calendar here. We are here Monday. We're going to finish up talking about Chapter 6. Homework 6.5 and 6.6 are due tomorrow. I recommend jumping into those as soon as we're done here because some of the concepts in especially 6.6 are a bit difficult to grasp right away. They are not intuitive. I'll go through some examples to help you sort of give you some tools to help you solve some of those problems on the homework. Realize we've got an exam this Friday. So Wednesday, we'll have a review session, talk about what's on the exam, what you need to watch out for, some tips on how to prepare. I'll get some practice exams up on Blackboard. I'll get some practice questions up on my accounting lab soon. And be ready on Friday to have your exam during normal class time as per usual, this time covering chapters 5 and 6. Without further ado, I want to go into 6.5 first and talk, harken back to the periodic inventory system. 6.5 talks about using the cost of goods sold model. It's sort of just it's like the flip side of the same coin, basically. The periodic inventory system only captures cost of goods sold, usually at the most at the end of the year. So during the year, usually there's only one journal entry. That's when we record sales. Under the perpetual method, we record sales and update cost of goods sold. But under the periodic method, they say, you know what, let's just figure out cost of goods sold at the very end of the reporting period. And the way they can do that is by taking beginning inventory, adding purchases to get what's called goods available, and then subtracting whatever they physically count in inventory at the end of the period. The difference there being cost of goods sold. And just going to give you a visual about what that is imagine we have beginning inventory of $100. We purchase $500 worth of inventory. So total goods available is $600. It's somewhat of an intermediary step to calculate goods available for sale. It's important to do that when you're working through problems, especially on the homework and on the exam, is to take a step back and ask yourself, hey, what are the total goods available? So before you start applying FIFO, LIFO, average cost, that's an important step, I think, is capturing those. I put those in on the PowerPoint slides that I emailed you guys last week. So if you have any questions about that, by all means, come and see me. If I have goods available for $600 and then at the end of the period, I go out to the warehouse and I count $200 worth of inventory, I can see that, well, if I had 600 and I have 200 left, I had 600, now I have 200 left over, then I must have sold 400. It's a bit of a rough estimate of what cost of goods sold is. Generally speaking, if the amounts that are no longer there, it must have been the amounts that have been sold. It's also possible, that we had some people with sticky fingers. Maybe there was some theft that occurred. Obviously, retail companies and manufacturers have issues to deal with regard to that. But just understand that, generally speaking, aside from shrinkage, which is what they call theft, by the way, shrinkage, not like coming out of the pool and there's shrinkage, but if there is theft, generally speaking, they just write that into cost of goods sold. So again, cost of goods sold, it can be, some people look at it as inventory expense. It's not just an expense, the consumption of inventory, it also incorporates losses too. So that's what they call the cost of goods sold model. It essentially follows the periodic inventory system of calculating cost of goods sold. So we're going to take a look at this in more detail through 6.5 and 6.6. Here's the problem with this model is, what if we didn't count the ending inventory? Meaning we knew what goods available were, but for whatever reason, maybe there was a fire, we lost all the inventory, we weren't able to count it. If we don't know what ending inventory is, we have two unknowns but one equation. So we don't know ending inventory, we can't figure out cost of goods sold. The VAS becomes at us and says, look, bad things happen. So an appropriate way to deal with this is to estimate what ending inventory is using what's called the gross profit method. The gross profit method essentially relies on the historical or the normal gross profit percentage as a means to first determine or estimate what cost of goods sold is, then work backwards using the cost of goods sold model to determine or estimate what ending inventory probably was. So it's using estimates in accounting, that's a reality. We're not always just spot on. In fact, someone once said that they chose to major in finance because accounting had too many estimates involved, and they quickly realized that estimations are just a fact of life. We have to make guesses, we have to make predictions. So a lot of what you see in 6.5 and 6.6 are just estimations. So in this case, kind of similar to what we saw in slide 5 of 6.4, assume that we had net sales of 1,000. Beginning inventory was 150. Net purchases in this case were 950. We didn't do an inventory count, or we don't have a reliable inventory number, whatever. We don't have a number we can bank on at the end of the period. But we know that the normal or typical gross profit that we experience year after year is about 15%. With this information, can we estimate cost of goods sold? And then from that, can we estimate ending inventory? And the answer is yes, we can. First thing we want to do is start on the income statement. We want to look at the gross profit percentage, multiply that times the 1,000 to estimate first what must be gross profit. And this is just an estimate. So we assume that our gross profit that we've earned during the year or the period is 150. That's fine. FASB says as long as that gross profit percentage is pretty accurate, then go ahead and use that as part of your calculations. If gross profit was 150 and net sales revenue was 1,000, then we can estimate cost of goods sold to be 850. That's okay. 850 is probably what we sold during the period. If that's the case, carry that over into the cost of goods sold model and plug it in as the bottom line. We know what beginning inventory is. We know what net purchases were. So we can just work backwards. Using a little bit of algebra, determine our ending inventory must have been 250. It's an estimate. And the key thing to realize is that it relies heavily, in this case, on the gross profit percentage. So the gross profit percentage, which we talked about in the last class, it's good for a lot of things. And this is just one of the ways we can use gross profit just to estimate what our ending inventory is if for whatever reason we forgot to count or we were unable to count the inventory. But realize that, regardless, there are a lot of different ways of sort of just managing and measuring inventory throughout the period. And doing these types of calculations, it sets you apart from the other business professionals because using some deductive logic and critical thinking, you can make these determinations logically. What if we know what ending inventory is? We know what beginning inventory was. We know what cost of goods sold was during the period, right? All of our records are accurate. Realize that we can keep great records, but those records aren't just good, reliable about showing us what happened in the past. We can use accounting information to make predictions going forward in the future. So a lot of you management majors out there and finance majors, you'll have to do some projects in your 300 level class, 3,000 level classes where you'll have to make forecasts of revenue, forecasts of expenses, and things like that. What I'm going to show you here is how we can use the inventory information to forecast what we need to budget for in terms of future inventory purchases. This is necessary. Budgeting in for-profit institutions is a given, but especially for nonprofit organizations like churches and especially governmental organizations, they rely heavily on budgeting, and accurate financial accounting records are the starting point. So what we're going to do here is we're going to forecast what net purchases needs to be for the next period using a series of information. This is kind of complicated because it requires us to use a lot of estimates and forecasts. So to estimate or budget for inventory purchases in the next year, we need to first forecast a forecast of net sales. Generally speaking, the forecast of net sales is a starting point for all forecasts. And the reason why is, as you recall from the expense recognition principle or the expense matching principle, we match expenses in the same period of those revenues that have been earned. So expenses are expected to go up as revenues go up. So if we can accurately predict what revenues are, we can accurately predict then, as a result, what expenses must have to be to make those revenues happen. So a starting point for any type of budgeting is really with net sales or sales revenue. So because it represents demand. Now from there, can we provide a supply to meet that demand? Well, we're going to use net sales revenue as well as some other information to forecast cost of goods sold and forecast what the beginning inventory, what the forecast of beginning inventory needs to be to make all of this happen. There's a series of calculations. And realize too that forecasts are nothing more than just kind of creating a buffer. or some sort of like safety net or safety amount, like in your checking account, right? Some people, they keep $500 in their checking account just for in case of emergencies. We're kind of doing the same thing here, only we're not just predicting how much we need to have at any point in time. We're also predicting what we need to put in our inventory to make sure that we meet the demand, the sales. So down below, I'm going to give you a series of information. Don't get overwhelmed by this. You have to take it little by little. So imagine it's December 31st, 2020, and we need to estimate how much inventory to purchase in the next year, 2021. Okay. We have actual records, actual data, and that's accurate. We had beginning inventory for 2020 of 100. We added 850. We had an ending balance of 150. So our cost of goods sold was 100. Assume these are all accurate. Cost of goods sold was 100. Cost of goods sold was 800. Revenue was 1,000. Gross profit was 200. We had a gross profit percentage of 20. All that's well and good. How can we use that as well as forecasted information? Well, here's the forecasted information that we need to focus on. The revenue for 2020, 2021, and the revenue for 2022. We're going to use that. Okay, that's a good forecast to help us figure out what the demand is going forward. We also have to acknowledge that gross profit, assume, in this case, that gross profit percentage of 20%, assume that's static. That's a key input as well. We're kind of relying on forecasted revenues, and we're relying on the consistency of the gross profit. And remind you too, it's reasonable to assume that gross profit percentage will stay the same because gross profit percentage is simply the markup above cost. As long as we know we're going to keep that static or within a certain range of consistency, then it's okay to make that assumption that gross profit percentage will stay the same. One key thing that all inventory managers must do is figure out how much ending inventory they need on hand at the end of the period. So in this case, let's assume that our ending inventory equals 10% of the following year's forecasted sales revenue. That's just how we're making that determination in this case. If you look up above, you can see that our ending inventory for 2020 is 150. That was not magical. That was done deliberately because it was predicted that we needed that revenue in 2021, the next period was going to be 1,500. So we just made sure at the end of the current year that we had 10% of those forecasted future sales on hand as inventory at the end of the current year. What do we need? This is all well and good, but the bottom line is, what do we need to determine the net purchases? Well, that's what we're going to see here. So let's skip down. We're going to flip through a bunch of slides here just to sort of kind of focus in on what you need to worry about. So on slide number 6, we need to figure out, this is the key figure here, we need to figure out what purchases are going to be for 2021. Given the cost of goods sold model, we need to figure out what is the 2021 beginning inventory right here. We need to estimate what 2021 ending inventory is going to be right there. And we also need an estimate for cost of goods sold for 2021. If we can figure those out, we only have one unknown, one equation. We can figure out what purchases needs to be. This is usually how most budgeting occurs. Usually we tend to look at a trend analysis or historical data to figure out a trend. But generally speaking, at the end of the day, a lot of budgets are just about what do we plug in to make this thing balance. So there's not a whole lot of magic when it comes to budgeting. Trust me on this. First things first, beginning inventory of 150,000. This is slide number 7 here. Beginning inventory for 2021 is last year's ending inventory. So ending inventory for 2020 is 150. So that's going to be our beginning inventory for the next year. We're just rolling this forward. Inventory is an asset account. Asset accounts are permanent accounts. We just roll forward the balances. We don't close them out. So there's the balance. We got one thing taken care of. That one seems pretty simple. We just take one number, plug it in. Next one is we have to figure out or estimate what ending inventory is going to be. So next one down, we're estimating 225 as our ending inventory for 2021. How did I come up with that? Well, recall that I need to look ahead at the end of 2021. I need to look at the 2022 forecasted net sales and multiply that by 10%. That 10% of forecasted sales represents the amount based on my policy, represents the amount that I need to have on hand at the end of the 2021 period. So I'm kind of almost having to look 2 periods ahead for sure to figure out what I need to have at the end. That's fine. Sometimes you need at least 2 years forecasted data. That seems reasonable in this case. 225 is what we need to have on hand. We got 2 numbers, 1 more left to go. Now, down below on slide number 9, I say, in order to figure out cost of goods sold, the last unknown, I need to figure out first what is gross profit. So this kind of looks at the gross profit method to determine what cost of goods sold is. So first things first, I'm going to multiply the 20% expected gross profit rate times the 2021 expected sales revenue. So 20% is, again, what I predict is going to be the gross profit percentage consistently. So I take that and I multiply it by the forecasted sales, 1,500, and that's going to give me a gross profit of 300, just as we saw before. Okay, not quite done yet. Next slide down, we're going to work backwards and say 1,500 is the starting point, 300 is the ending point. So cost of goods sold is expected to be next year about $1,200. Okay. Again, we're relying heavily on our forecasted supply, forecasted demand, and so our forecasted supply is going to be $1,200 in cost of goods sold. That's the amount I'm going to plug in to the cost of goods sold model. I have now 3 numbers. Cost of goods sold is $1,200. So what's the last little bit I need to do now? Go to slide number 11. Slide 11 says, okay, you've got beginning inventory, you know ending, you know cost of goods sold. Just do a little bit of algebra, which is, again, I know algebra is still a sticky point for some people. People don't like math and accounting. That's about as complicated as we get here. So all I'm simply doing is putting in the accounting equation, beginning plus purchases minus ending gets me cost of goods sold. Put everything on the right-hand side except for purchases, and you can figure out the purchases. We expect to buy $1,275 worth of inventory next year. How did I get that? Again, I relied on a lot of forecasting and a lot of expectations, but this is reasonable. So long as my inputs are reasonable, this calculation works. So there's some homework problems that have you kind of like work through this. I honestly think that you're going to have to do it step by step. So when you get a chance, take some time and scribble these notes out on a blank piece of paper just so you can know the process, how it works, because the homework, you kind of get over reliant on the homework will tell you like, hey, fill in this box with this number. If you don't know why, you need to ask yourself why. Make sure you understand that, because that's a key component in going into the exam is understanding why you're doing things. 6.6 is somewhat of a continuation of what we just talked in 6.5 about. In 6.5, we talked about estimating ending inventory, budgeting net purchases. 6.6 is a beast in and of itself because it's not intuitive. This is a situation where previously we relied on counting inventory accurately, but we know that counting inventory requires people to do the work and at least be sober when they're doing the counts. So it's possible that there's human error when it comes to counting. Trust me, I did this stuff when I was at PwC, so I know that when people are subject to making mistakes when it comes to counting, it's not always that straightforward. Remember from 6.1 and 6.2, we talked about all the different legal ramifications, such as goods on consignment, goods we don't see but we own that we need to include. There's a lot of reasons why a count can be screwed up. So what sort of situations arise if we count things incorrectly? Well, we could get a situation of inventory being understated, meaning balance is too low. The count we make is too low. That could happen because we forgot to include goods out on consignment, like I just said. It's also possible that we could overstate our inventory, meaning the balance can be too high. If the balance is too high, that usually can arise where maybe we included inventory that doesn't belong to us. Maybe it's sent on consignment to us and we shouldn't be counting it because we don't own it. It's really belonging to the supplier or the manufacturer. Lots of reasons why we can have a mistake in the count besides lack of sobriety from the people who do the counting. Anyway, so the issue here is, how does an incorrect count affect the financial statements? Believe it or not, if we screw up a count, it can affect not just 1 year's worth of financial statements, it can affect 2 years worth of financial statements. One error has a trickling down effect. It just exacerbates everything. So let's go through an example. Starting on, this is slide number 13 here. So 1A, assume that the 2020 ending inventory is understated by 15. We forgot to count something. So it's understated, it's too low. How will the 2020 cost of goods sold and the gross profit be affected? Okay, let's just focus on 1 year at a time here. My recommendation is to sketch out a very simplified example. The book says, here's the pattern, and a lot of people, most students are compelled just to memorize the pattern, even if it doesn't make sense. I say you got to kind of like see it. And so I recommend sketching out a simplified example like this. Assume the true records, the reality is as follows. And this is kind of simple, but it's not stupid if it works. Assume my beginning balance is 100. I buy 100. That means I have 200 goods available. I have left over 100, which means my cost of goods sold must have been 100. I know it's simple and stupid, but that's okay. If my cost of goods sold is 100, assume my revenue is 1,000. My gross profit, in this case, 900. That is without any errors. It's a simplified example. Is it the reality? Doesn't really matter. Okay. So oftentimes in these homework problems and even on the exam, you're just given information about how much inventory is messed up. All you really need to do is just kind of know the effect. So assume that everything is correct except for the ending inventory. Remember, ending inventory in this case is understated. So the inputs on the right are all okay except for ending inventory. Ending inventory is understated. It's too low by 15. How does that math play out? 100 plus 100 minus 85 means cost of goods sold would equal 115. 115 versus what should be 100. In this case, you can see that by having ending inventory be too low, cost of goods sold is going to be too high. That's a pattern. If ending inventory is too high, cost of goods sold would be too low in this case. But here we're saying that ending inventory is too low, cost of goods sold is too high. How does that affect the income statement? Assume revenue is okay. Cost of goods sold being too high means gross profit is too low. In fact, let's ignore all the SG&A expenses. Let's ignore salaries. Let's ignore taxes. Let's ignore all the other types of expenses. Let's just say that we know that net income is going to be too low by 15, ignoring taxes and other expenses. If that's the case, how will our financial statements be jacked up? Well, in the case of assets equals liabilities plus equity, right? Inventory is too low, so assets are too low by 15. If net income is too low, then retained earnings is going to be 15 too low, which means total stockholders' equity is going to be too low by 15. So we have this error that doesn't just affect assets, it affects our overall equity too. The balance sheet can still balance and still contain an error. That's the key thing to remember here, is that we want our debits to equal credits, but we're relying on the fact that the amounts that we input are correct. Okay. In this case, the amounts we inputted for 2020 are incorrect. But that's not just the only set of financial statements that's jacked up. Assume now in 2021, we don't fix the error. Assume the error was not fixed in 2020, and we start 2021 assuming everything is all hunky-dory. Realize that ending inventory being understated for 2020 means 2021 beginning inventory is going to be understated as well. We didn't check to see if the count was accurate, so we ended with a bad number. Now we're starting the next year with a bad number. In other words, we just take this amount and we start the next year not with what should be the case, but what we actually thought was correct. Beginning inventory in this case, in 2021, is going to be 15 too low. How does that affect the overall financial statements? Well, play it out. 85 is going to be the cost of goods sold versus what it should be, 100 meaning that cost of goods sold in this case is going to be too low. So 2020, we saw that ending inventory was too low, therefore cost of goods sold was too high. Now we're in 2021, where beginning inventory is that because of prior year end is too low, therefore cost of goods sold is too low. That pattern will always be the case. All right. If you switch up, which we'll see here in a second, if we switch up the ending inventory being too high, all the other signs get switched up as well. But that's kind of like a visual. I would recommend just kind of going into the homework and the exam, having that in your head. That'll kind of keep things straight, even if it's not quite clicking yet. Okay, but the example, as long as you know the math works, it's not magical or mysterious. It's just mathematical. So given that the 15 is too low for cost of goods sold, plugging into the income statement, you see that it results in net income and gross profit being too high by 15. So this is kind of interesting. You see that last year it was too low, and next year is too high. It's switch. It flips in this case. So the gross profit effect, the net income effect, the cost of goods sold effects, they just flip in the following year, assuming that it doesn't get fixed. 2 years worth of financial statement data is messed up, okay? But there is one consolation from all of this, assuming we still don't catch it by the time the books are closed. Compare what is good on the left-hand side, assuming that we have a very simplified set of financial data here. Gross profit in 2020 was 900. Assume that net income is the same. In 2021, gross profit, net income, again, ignoring taxes, ignoring other types of expenses, right? Let's just assume in a perfect world, okay, this is a perfect world situation here. If we made all the counts accurately, we would see that, assume that beginning inventory is 0, net income is inserted in there, ending retained earnings is 900. For 2021, we start off with 900 as my beginning retained earnings. We add another 900 for net income for 2021's net income. And then we have ending retained earnings of 1,800. Okay, so in a perfect world, we would see that ending retained earnings at ending 2021 retained earnings should be 1,800. How jacked up is our financial data given that we've had this error that we didn't fix? Okay, now remember, we close out all the revenues and expenses into retained earnings. So in this case, the expenses are the items that have the error. So 2020 had a wrong cost of goods sold, but so did 2021. It also had the wrong cost of goods sold. So we got errors that are going into retained earnings. How do those things affect each other? So here we see 2020 as recorded. This is the bad. This is the, oh God, we screwed this up. Cost of goods sold. So net income, assume gross profit, net income 885 for the first year because cost of goods sold was messed up. That goes into retained earnings. Ending retained earnings for 2020 is 885. That amount becomes next year's beginning retained earnings. So 2021, I now have a flip sign where I got net income that's too high by 15. That gets inputted into retained earnings when we close the books. But guess what? If we don't fix the error, we still end up with the correct amount of ending retained earnings. This phenomenon is what's known as a counterbalancing error. If we do not fix the error in either period, the error will fix itself. It's not magical, it's just mechanical. It's just the way it flows through. One side it was too low, the other side's too high. If one side's too high, the other side will become too low. Now, it doesn't mean we're off the hook. It just means that we don't need to do an adjusting journal entry at this point. However, given that the records are all fixed, here's the problem. The individual financial statements are still wrong because the income statement, if anything, shows incorrect cost of goods sold in 2020. It shows the incorrect cost of goods sold in 2021. It shows incorrect net income in 2020 and incorrect net income in 2021. So the financial statements, which take a snapshot of certain periods, those will still be messed up. But do we need to do anything in our accounting system? Do we need to input a journal entry to fix anything? At this point, no, it has fixed itself. So just going to realize in 2020, okay, assets equal liabilities plus equity, right? And we acknowledge that it was too low in 2020 and retained earnings was too low, therefore equity was too low. But in 2021, assets equals liabilities plus equity. The assets now, there's nothing wrong with the ending assets. Ending, where's that sucker? Right here. Assuming that, yeah, there it is. Assuming ending net inventory is fine, then our total inventory, our total assets are going to be fine because total inventory is fine. That means by virtue, equity must also be fine. So everything looks fine on the balance sheet in 2021, but the income statement itself will show the wrong cost of goods sold and the wrong net income. Prior year's financial statements, 2020, definitely messed up, right? Income statement and balance sheet. 2021's income statement still messed up. 2020's balance sheet looks fine. Okay. What if the sign was flipped? What if 2020's ending inventory is overstated, not understated? In this case, it's overstated by 20. We counted too much inventory. Again, go through, sketch out an example. I recommend seeing it. If you do it a couple times, it may just make sense to kind of have like a little cheat sheet in your head that you can sort of consult for any patterns. If ending inventory 2020 is overstated, let's throw in 120 versus the 100, and we can see in this case it's too high by 20, therefore cost of goods sold is too low. If cost of goods sold is too low, that means that net income is going to be too high. So same process as we've seen before, we're just flipping the signs in this case. Now, as you know, we have assets equals liabilities plus equity. This is for 2020. We know that ending inventory is too high. We know that also this effect on gross profit, assuming it also affects net income directly, 20. That means retained earnings is going to be too high by 20. So retained earnings is too high. Overall equity is too high. 2020 financial statements, the year of the error, that is jacked up. That is messed up. Ending inventory should be fixed at this point. But let's assume that we don't fix anything. We just roll with it. Okay. Or maybe we accidentally don't see it. We turn a blind eye, as they would say. Let's just kind of ignore it. Maybe it will go away. Well, in this case, maybe it will, but the financial statements will still tell a different story. If we don't, assume the error was not fixed in 2020, 2020's ending inventory was overstated by 20. Therefore, the 2021 beginning inventory is also going to be overstated. We're just going to carry forward the messed up number. So in this case, bring it over. There it is. Beginning inventory is now too high by 20. Last year's ending inventory was too high. We run through the math. We can see that cost of goods sold is going to be too high. The error carries forward to the beginning portion. If we have cost of goods sold that's too high, we have net income that's too low. So the pattern in this case is, again, 2020, the ending inventory was too high. Therefore, the cost of goods sold was too low. In 2021, you have beginning inventory being too high. In this case, cost of goods sold is also going to be too high. That's just the pattern. Okay? And that will always be the case, or it will be what we saw in the first example. Example 1B is what we saw when we had the flip signs flipped. So again, look at this. We got this. It was the net income, gross profit was too high in one period, and then it was too low. The signs flip. Okay, and now you know that they flip. You know that these errors will kind of counterbalance each other. The financial statements will be jacked up, but at the end, if we don't fix anything, retained earnings will still be fine at the end. 1,800, and the reason why again was because the signs flip themselves. So 2020, assets equals liabilities plus equity. It was too high. Equity was too high in 2021. What we see are assets are up here, and the assets, assume those are okay. It was just the beginning inventory that was jacked up. Ending assets are fine, therefore total assets are fine. The errors counterbalance themselves in retained earnings where everything goes, therefore equity. Ending retained earnings is fine, so equity is going to be fine. The error fix itself. Let's just again be clear about this. The error will fix itself because it's a counterbalancing error. But the individual financial statements for 2020 and 2021 will show erroneous data, specifically on the income statement. Cost of goods sold, gross profit, net income, those numbers will be wrong in both the 2020 and 2021 financial statements. The balance sheet will be wrong in 2020. The balance sheet will look fine in 2021 because at the end of the day, the errors will fix themselves. It's not magical, it's mechanical. Those are the notes I have for the 6.5 and 6.6. I want to just let you know that the homework, you want to jump in on that right away because a lot of this stuff is not intuitive. Hopefully you've been reading before you come to class. For a lot of people, that tends to be the big turning around point for them to improve their scores. But if you have any questions, please let me know. Are there any questions out there for you people? I'll hand over the floor to you guys.